Welcome back to the Microlearning Institute. In this tutorial, we're going to prepare a consolidated statement of profit and loss and other comprehensive income for the year ended the 30th of April 2014 for the Marchant Group. Now, the Marchant Group comprises three companies. Marchant is the holding company and Nathan an option. So firstly, let's look at the fair value of the net assets of Nathan at acquisition. So we're told in the question that at the date of acquisition, the ordinary share capital, the retained earnings and the other components of equity of Nathan were $25, $65 and $6 million respectively. We're also told that the fair value of the net assets of Nathan at acquisition were $110 million. So as a balancing figure, we can conclude that there was a fair value adjustment needed in order to bring the net assets of Nathan into the group accounts. And we're told in the question that this fair value adjustment relates to non-depreciable land. Now that we know the fair value of the net assets of Nathan, we can look at the calculation of goodwill in Nathan at acquisition and subsequently. The cost of the group share of Nathan was $80 million, and for that the group acquired 60% of that fair value of net assets of $110 million, and consequently recognized goodwill in the group at acquisition of $14 million. Company policy is to value non-controlling interest at fair value. Fair value non-controlling interest in Nathan at acquisition was $45 million. We match this with the 40% share of the fair value of net assets of Nathan that are allocated to non-controlling interest, and that's $44 million. So we recognize $1 million of goodwill in the non-controlling interest at acquisition, giving us a total goodwill recognized at acquisition of $15 million. Now, we're also told in the question that there has been an impairment since acquisition of 20% of the goodwill originally recognized. So this is 20% of 15, which of course is $3 million, and this 15 is now allocated to the group and the non-controlling interest in proportion to their 60% and 40% shareholdings respectively, giving us a closing goodwill in the group of $12.2 million and a negative goodwill in the non-controlling interest of $200,000 and a net overall total goodwill of $12 million. Next, we look at the disposal of the 8% holding in Nathan. Critically, as the Marchant Group already held 60% of the shares of Nathan, disposing of 8% still leaves them with 52% of the shares, i.e. they don't lose control. So because of this, the disposal of these shares is treated as a movement in equity. Because we don't cross the control threshold, that is 50%, any movement in shares, any change in shareholding is regarded as a transaction between owners of the business. It doesn't change the control status and consequently is accounted for as a movement in equity. So let's look at how this disposal of the 8% holding will be treated. Firstly, let's look at the separate accounts of Marchant. So the proceeds, we're told in the question, is $18 million, and the carrying amount is 8% of the 60% that we already had, for which we paid $95 million. So this has a carrying amount of 12.6, giving us a gain on disposal recognized in the individual accounts of Marchant, not the group accounts, of $5.4 million. Now, of course, this gain, we'll see later, will be eliminated on consolidation. Next up, let's look at how the same disposal of 8% holding will be treated in the group accounts of the Marchant Group. Because we don't cross the control threshold, we don't remeasure everything to fair value. Instead, we compare at what value are we carrying the 8% holding versus what are the proceeds we received for the 8% holding, and we recognize any difference as a movement in equity. So let's look at this. So the net assets of Nathan at the date of disposal of the 8%, we're told in the question, is $120 million. There's a fair value adjustment here, of course, that we initially recognize in relation to non-depreciable land, giving us a carrying amount of all of Nathan of $134 million. The 8% share then is valued at $10.72 million, and you might also remember that we recognized goodwill in in the carrying amount of Nathan. Now, goodwill of 12 was recognized in the 60% of the group share, so we need to adjust that to represent how much goodwill is represented by the 8% share, and this equates to $1.6 million. So the total carrying amount of the 8% holding in Nathan at the date of disposal was $12.32 million. Of course, we know that we received proceeds of $18 million, so consequently the difference is treated as a gain to equity of $5.68 million. Next up, let's look at the fair value other comprehensive income gain that was recognized on this transaction. In line with IFRS 9, in the individual accounts of Marchand had elected to treat any gains or losses through other comprehensive income in relation to its shareholding in Nathan. We're told in the question that the fair value of Marchand's shareholding in Nathan at the 30th of April 2013 was $90 million, and this had moved to $95 million 1 year later. So, in the individual accounts of Marchand, the change in fair value of the investment in Nathan of $5 million was recognized, and of course again this gain will be eliminated on consolidation. Next up, we look at the acquisition of option. Again, we're told in the question that we paid $70 million for a 60% share in option whose fair value net assets at that date of acquisition were $86 million, thus recognizing goodwill in relation to the group share of option of $18.4 million. Similarly, we're told that the non-controlling interest in option at the date of acquisition was fair valued at $28 million. And again, we match this with the 40% share of fair value net assets, giving us a negative goodwill in the non-controlling interest of $6.4 million and a net total goodwill in relation to the acquisition of option of $12 million. Next up, we look and see the transactions involved in moving from a 60% interest in option and disposing of a 40% share, leaving us with a 20% share, which is going to be treated as an associate. When our shareholding in option moves from 60% to 20%, we cross the control threshold, the 50% control threshold. And of course we, the Marchand Group, we lose control of option. And again, the policy here is to remeasure everything to fair value, remeasure the entire entity to fair value, and compare that with the carrying amount and recognize a corresponding gain or loss on the disposal. So let's have a look at the carrying amount of option on the date of the disposal of that 40%. The carrying amount is made up of net assets of 90 plus associated goodwill, that totaling $102 million. The fair value then is made up of the proceeds which we received for the amount that we sold of 40%, the value, a fair value of the 20% that we retained, and also the fair value of the non-controlling interest at the date of that transaction. So the total fair value of the option entity was $124 million. So if we were carrying it at $102 million and its fair value is 124, when we remeasure to fair value, we get a gain on remeasurement to fair value of $22 million. And this gain is recognized in profit and loss. Next up, let's look at the treatment of the pension fund. We are told that the opening assets and liabilities of the pension fund on the 1st of May 2013 are $48 million and $50 million respectively. We're told that the current service cost is $4 million. Now this current service cost is treated as an addition to the liabilities of the fund and is also recognized as an expense in the P&L in the period. We also have an expected return on the plan assets of 10%. So 10% of the assets of 48 will give us an income of $4.8 million, which of course is treated as an asset in the fund and is also treated as a reduction in expenses in relation to the pension through the income statement. Next up, we have interest on the liabilities at 10%, which again is treated as an addition to our liabilities in the fund and is also treated as an expense in the income statement. A past service cost similarly is treated as an addition to the liabilities of the fund and also as an expense in the period in which it is recognised through the income statement. And we also are told about remeasurement gains in the period of $2 million, which again are additional to the liabilities of the fund and are also recognised in the income statement. The current service cost, the net interest and the past service cost are netted off to P&L, and the remeasurement gains or losses are treated in other comprehensive income. So we can see in relation to the pension fund, the net pension expense is $7.2 million and the remeasurement gain to the fund is $2 million, again to other comprehensive income. Next up, let's look at the property, plant and equipment of this company. On the 1st of May 2012, we acquired property, plant and equipment at a cost of $12 million. We depreciated it over its useful economic life of 10 years for the 1 year to the 30th of April 2013, where its carrying amount is now $10.8 million. On that date, it was revalued to a new carrying amount of $13 million. So consequently, we recognized a revaluation reserve of the difference between 13 and 10.8, which is $2.2 million. Again, we continued to depreciate it over its remaining useful economic life, this time being 9 years, so we recognized depreciation for year ended the 30th of April 2014 at $1.4 million. So therefore, at the end of that year, on the 30th of April 2014, the carrying amount was $11.6 million, and we held a revaluation reserve in relation to this asset of $2.2 million. Again, the fair value on that date was deemed to be $7 million, so we needed to recognize an impairment from $11.6 million down to $7 million, and that's a total impairment of $4.6 million. Part of this impairment is recognized as a removal of the revaluation reserve in relation to the asset. So the revaluation reserve contained $2.2 million, so in order to recognize the impairment of 4.6, we first removed the 2.2 million from the revaluation reserve, but of course we still had an additional amount, which is an impairment expense, which is treated to profit and loss of $2.4 million. So you can see at the end of the period in relation to property, plant and equipment, we need to recognize an impairment expense to P&L of $2.4 million and also recognize that there is no longer a revaluation reserve in relation to this asset. Next, we look at IFRS 2 share-based payments. So Marchant, for year ended the 30th of April 2013, recognized 8,000 share options for each and anticipated that 4 directors would avail of these options. The fair value at grant date was $100 per option, and Marchant expected that these options would vest over a 3-year period. So, in line with IFRS 2, Marchand recognized the equity in relation to these share-based payments of 1.07, and of course the corresponding expense to the income statement. At the 30th of April 2013, the expectations had changed, and now we expected 6 directors to avail of the offer. Again, the fair value at grant date was still $100, and now we're 2/3 of the way into the overall vesting period of 3 years. So now we recognize cumulative equity of $3.2 million, and of course a corresponding expense relating to the movement from 1.07 to 3.2 million in equity of $2.13 million. Now we can begin to prepare the consolidated statement of comprehensive income. So to prepare the consolidated statement of comprehensive income, we recognize the revenue of Marchant and Nathan in full. And of course we had a subsidiary relationship with option for 6 months of the year before we disposed of that 40% to subsequently have an associate relationship. So here we have Marchant, Nathan and 6/12 of option giving us a revenue. Now, of course, we had an intercompany sale given to us in Note 4 of $12 million, which we eliminate on consolidation. So the consolidated revenue equates to $538 million. Similarly, in relation to cost of goods sold, we again take all of Marchant's, all of Nathan, and 6/12 of options cost of goods sold, and again we eliminate the intercompany cost of goods sold. Just a note in relation to note 4, as the goods were transferred at fair value, there is no intercompany unrealized transfer profit, so there's no adjustment for unrealized transfer profit in the closing stock of the receiving company. So again, our cost of goods sold equates consolidated to $383 million, giving us a gross profit figure for the period of $155 million. Next, we look at other income, and again we take Marchant, Nathan, and 6/12 of option, but we also recognize the loss to equity here of the sale of the 8%. And additionally, we recognize the gain on remeasurement when we remeasured to fair value when we disposed of the 40% share in option. We remeasured to fair value and we recognized a gain on remeasurement, giving us a total other income of $45.6 million. Next up, we have admin expenses, and again the adjustments to the admin expenses are the goodwill impairment that we recognized in relation to the goodwill in Nathan. And also we're told about goodwill reversal. We're told about this in note 1. At the end of note 1, we're told that the goodwill has been reversed to $2 million above its original value. And of course we cannot recognize internally generated goodwill, so we must remove that and recognize it as an expense, giving us a consolidated admin expense of $35 million. Our expenses consolidate at $58 million, and again a share of an associate. The associate is option, so again the $15 million in profit that option makes, we, the group company, are entitled to a 20% share of that, but of course only for the 6-month period where we have the associate relationship with option, the other 6 months being a subsidiary relationship. So that share of associate is $1.5 million. Next up, and again we've done a working to show an income statement expense in relation to the pension of $7.2 million, and the impairment to P&L in relation to property, plant and equipment of $2.4 million, the share-based payment in relation to the options of $2.13 million. Finance costs consolidates at $13 million. The hedge is reclassified to other comprehensive income. So it's removed from here and it's reclassified to other comprehensive income. Finance income consolidates to $15 million, giving us a profit before tax of $102.51 million. Tax consolidates to $30.5 million, giving us a profit after tax of $71.01 million. Now we can look at the hedge loss, which rightfully now appears in other comprehensive income. And there's a revaluation loss relating to property, plant and equipment, which of course also appears in other comprehensive income. The pension, the remeasurement gain, the remeasurement loss expense in relation to the pension of $2 million, and the goodwill write-back in relation to the acquisition of Nathan of $5 million appears as other comprehensive income, giving us a total comprehensive income for the period of $69.81 million. Thank you very much for watching this tutorial from the Microlearning Institute.